So, very good afternoon, students. Hope you are fine. Hope you are safe, and hope you are enjoying your home stay. Today, we are going to discuss with the concept of journal and ledger. You know, accounting is a process of maintaining financial records. The business transactions are recorded in the books of accounts, and there are two types of books of accounts which are generally involved in. One is journal and the next is ledger. Ledger is the principal book of accounts, and all final postings are transferred to the ledger from the journal, and this is called posting. So ledger is the principal book of account, and all accounting information can be secured from the ledger. Posting of the entries in ledger is made from journal, as I have told you, and a journal is a primary book of account or also called subsidiary book of accounts. All entries as and when made are first recorded in the journals, and from journals those entries are finally transferred to the ledger. So ledger is the final book of account. Journal is the principal book of account where all systematic records are maintained, and it is a book of permanent records of financial nature. Then entries are made chronologically on the basis of the source documents. Chronologically means as per the date when they happens, when they are formalized, when they are done. So entries are made chronologically on the basis of the source documents, and as I have already told you in the previous class, source documents are a voucher. A voucher is nothing, it is the record of transactions of an organization, like bills, receipts. These are all the type of kind of a voucher. So a voucher indicating accounts to be debited or credited is prepared and recorded systematically in the journal. A journal is the primary book of account in which transactions are originally recorded in the chronological manner I have already explained. It is the book of original entry. Since the transactions as and when are made, recorded originally in the journal, recorded first in the journal, it is also called the book of original entry. Records are thereafter transferred to the ledger. I have already told you. A journal is a chronological record of financial transactions of business, defines MG Keeler. So MG Keeler defines a journal as a chronological record of financial transactions of a business, and a business makes several kinds of financial transactions we have already discussed in the previous classes, and all those records, those financial records are maintained in the journal using the rules of debit and credit. An entry made in journal is termed as a journal entry, and the process is called journalizing. So when we make an entry in a journal, it is called the process of journalizing. The transfer of journal entry is called posting. From journal, we transfer the records, summarized records, systematic records, analyzed records in the ledger, and that process is called posting. Journal has certain characteristics. It contains transactions in a chronological order. We must understand that a journal contains the entries as per the chronological order, as per the date when they are made. So this is the first thing. It doesn't record unsystematic way, haphazard way. The transactions are recorded in chronological order. It is the book of original entry. First entry are made in the journal. So it is the book of original entry in which transactions are analyzed before posting in the ledger. So it is not just recording. It is a process of recording the analyzed records before, and before posting, we make the analysis of the nature of the accounts, and accordingly we post in the journal as per the rules of debits and credits. Using double entry system of bookkeeping, it records both the debit and credit aspects of a transaction. Every transaction has two aspects. One is debit, next is credit. So it records the transactions as per the rule of debits and credit. It is a record that depicts the complete detail of a transaction in one entry. So in journal, we maintain a complete record of one transaction, in a single entry. The date, the day of transaction is recorded, then the particulars are recorded, then which account is to be debited is recorded, followed by the which account is to be credited. So and then a brief narration of that. So it records, it maintains a complete details of all transactions in one entry. So what are the steps in journalizing? When we go for journalizing, we follow certain steps because it is a scientific process of recording the information. So the first step is to determine what accounts are affected by a transaction. We have different kinds of accounts. We have personal accounts, we have nominal accounts, we have real accounts, we have purchase return accounts, we have cash accounts. So there are different types of accounts, and it is essential to see which account is affected by the transaction. So first is to identify which accounts are being affected by the transaction. Then the second is ascertain what is the nature of that account, the affected account. So this is the next step where we need to understand whether that account is a personal account or a real account or a nominal account. So nature of account, and it is a scientific process. It requires skills, it requires us understanding, and this is the second step. Then third step is applying the rules of debit and credit. Ascertain which accounts is to be debited and which account is to be credited. So this is very important that we must understand, we must recognize the nature of the account, and based on the nature of the account, one account is debited and the next account is credited. So it is necessary to ascertain which account is to be debited and which account is to be credited based on the nature of the account, and then applying the rules of debits and credit entries are made. The fourth is ascertain the amount by which the accounts are to be debited and credited. So this is the next step, and you know the accounting, in accounting we record, maintain the records, those records which are of financial nature, and then mention the amount of that transaction. So it is essential to ascertain what are the amounts which are to be credited and debited. Then fifth is write date, month and year in the date column. So a journal has certain columns. One is date, day column. Second is particulars column. Third is journal folio, where the page number of journal is mentioned, and then the amount. So these are the amounts to be debited and amounts to be credited. So these are the columns in a journal, and the first is that first entry is made in the date and day column, the date when the transactions are made. So write date and month and year in the date column. Generally we write the year at the top, followed by the month and the date. So entries are made writing year, month and date. Then next step is in the particulars column, record the name of the account to be debited with abbreviation for DR. So DR denotes debit in the same line. So same line we write. I will give you the example in the next slides. So we write the particulars column, name of the account to be debited, and the same line we write DR. So DR indicates that this account is to be debited. Then in next line, the amount to be debited is recorded in the debit column. Again, record the name of the account to be credited in the particulars column in the next line, preceded by the word to. So first we write to in the next line, and then the write the name of the account which is to be credited. So this is the systematic way of recording in the journal. Okay. And then in the credit column we write the amount that is to be credited. Then the next step is a brief description of the transaction called narration is written underneath in the next line in the particulars column. So after mentioning the credit, the account which is to be credited, underneath we mention a narration. And a narration is nothing, it is a brief description of the transaction. Then finally, we draw a line across particulars column to separate one journal entry from the other. In journals, we make several entries. So to distinguish one entry from other, we draw a straight line across the particular column. Then we have already discussed in the previous class, but again to refresh, I am here explaining that we have three types of accounts. There are three types of accounts in the accounting. One is personal accounts, then second is real accounts, and then third is nominal accounts. Personal accounts are those accounts of the persons or organizations, entities from whom the company has either to receive money or has to pay money. So personal accounts are nothing. It is the accounts of the personal entities, be it an organization or a business or a person, from whom the company has either to receive money. One company either receives money or pay money. So when the company has to receive money from a person or an organization, or a company has to pay money to a person or an organization, so that organization and that persons are the accounts of those organizations and persons are the personal accounts. Then second is real accounts. The firm also owns property. Every firm has real assets, real properties. So the firm also owns property like land, building, plant and machinery, stock, cash, etc. The accounts of various assets or property acquired by the firm are classified as real account. Suppose we are working in an organization. Sanjay Gandhi Institute of Dairy Technology is an organization. It has different kinds of real assets. It has building, it has furniture, it has so many things. So these kinds of accounts, the building accounts, these are all real accounts. Then third is nominal accounts, the accounts of various items which represent either income and gain or expenses and loss. Any organization either make payments, then earn income, or in the course of business make expenses to produce or incur loss. So the accounts of various items which represent either income and gain or expenses and loss of the firm are called nominal accounts. Nominal accounts contains what? It contains income or gain or expenses and loss. For example, accounts of rent, wage, salary, telephone bills, these are all the part of expenses. So these are such accounts are the nominal accounts. And then similarly, dividend received, interest earned, commission earned, these are the income for the organization, and thus it is also comes under nominal accounts. Then what are the rules of debits and credit? Already discussed, but again, when there is personal account, in case of personal account, debit the receiver. The rule is simple. Debit the receiver. Receive who is debit who is receiving the money. Who is receiving the money. So personal account, debit the receiver. Who receives the money, who receives the cash, who receives the goods, who receives the value. So this is personal account. Then credit the giver, who pays, who gives. So simple, when something is received by some person, his account should be debited, and something paid by the person, then the account should be credited. Then real account, the accounts of property. Here, debit what comes in, the value that comes in is debited, and the value that goes out is credited. So this is a simple rule. And then third is nominal
Sir,
account. Nominal account. So here,
sir,
yes, please.
सर जो रिसीवर और गिवर वाला है डेबिट और क्रेडिट सर
हाँ,
ये उल्टा नहीं है क्योंकि बैंक में अगर हम जमा
एक मिनट, आपकी आवाज नहीं आ रही है क्लियरली, पता नहीं इको हो
जैसे
रहा
मेरे
है. Something is echoing. So let us take this class, and at the last of class, if time permits, and even not, then we will arrange one more class and we will make a discussion. This is very important. It is very important to understand these concepts. So we will discuss, followed by a discussion. So we will definitely discuss. See the examples ahead. हमने example भी दिया है, and then if it is not clear, then we will discuss. So you have to read it again and again, try to understand it, and make some assignments on based on this. I will give you the assignments. So this is very important. Just listen, please. So the nominal account is the account of expenses and loss or income and gain. So when there is expenses and loss in an organization, then debit that account and credit if there is income and gains. Then a journal has typically 5 columns. This is the format of a journal, and it is an hypothetical. It is a hypothetical example of a journal. So you can carefully see this example. So as I told you, when we go for posting in a journal, what we do? First we mention the day and date. So first we have written here the year 2020, then May 1st. So this is the date and the year in which the transaction has been made. So this is the first column. Then suppose Ramesh is a person who has paid. Ramesh is a person who has cash received from Ramesh in payment of the amount due from him. So suppose an organization has due from Ramesh a cash of rupees 3,000. So Ramesh has to pay 3,000 in cash to the organization. So the cash account will be debited because their value is coming. It is being a personal account. Cash account is a personal account, and that account is debited. So here we have written DR. The cash account is to be debited, and the Ramesh account, which is also a personal account, is to be credited. Why? It is important to understand why. Because the organization, the cash account of the organization has received the value, is the receiver. The money from Ramesh goes to the cash account after the payment made by the Ramesh. So that account, that cash account is to be debited. And Ramesh has made, so the cash worth rupees 3,000 has gone from the hand of Ramesh to the cash account. So Ramesh account, Ramesh is a payer, Ramesh is a giver, so his account is to be debited. So in journal, LF, ledger folio indicates the page number of the journal, and at page number 60, it is a hypothetical example, please understand. So suppose at page number 60, we are maintaining a cash record, so we have written the number of that page of journal. So it is at page number 60. And the Ramesh account, Ramesh personal account is maintained at page number 24, so it is written on page number 24. Ramesh has paid 3,000 in the cash account, so the amount 3,000 has been debited, written under the debit column, and again the same amount has been credited to Ramesh because Ramesh has paid that. So the cash account is receiver and Ramesh account is giver accounts. Receiver's account has been debited and giver's account has been credited as per the rules of the debit credit, and both accounts are personal accounts. So this is very important that first of all, we should try to understand the nature of the type of the account, whether it is personal account nominal account or real account. Here, both the accounts are personal accounts. And one person, Ramesh, is one entity. Ramesh is paying, Ramesh is giver, and the next business cash accounts of the business is receiver. So cash account is debited and Ramesh account is credited. So recording in journal, we are going to deal to explain with certain examples how the recordings are made in a journal. Transactions are recorded in journal on the basis of source documents I have already discussed in accordance with the rules of debits and credits. Source documents are vouchers, bills, receipts, all these are source documents. So based on the information in the source records, transactions are made, the entries are made in the journal. Let us consider first example. Ramesh started business and invested rupees 5 lakhs on 1st May 2019 in cash as a capital. When a proprietor starts a business, he makes investment in that, and that is called owner's equity or capital. So he invested as a capital rupees 5,000. So this rupees, and you know, in accounting, what we consider? We consider owner as a separate entity and business as a separate entity. So we have here two accounts. One account is business account and second account is Ramesh accounts. In a business account, there is a cash account and Ramesh is the person whose accounts is also there, maintained separately. So Ramesh started a business by investing rupees 5 lakhs. So we have first written, as per the norms, the year, month and date. Then here we need to understand the nature of the account. So cash account is debited, right? And Ramesh account is credited. And you must take note of that how we have entered it. We have written under particulars cash account, then given some space, and then recorded DR. So this cash account is to be debited. This cash account is being maintained at the page number 51 of ledger folio, journal, the book of journal. So this is page number 51. And the amount debited is rupees 5 lakhs. Then in the next line, how we have maintained the record? We have written 2. And then we have written the name of the Ramesh. Ramesh is the owner. Ramesh is the person who has invested rupees 5 lakhs. So we have written to Ramesh capital account. And then we have given a narration, brief narration under being the amount invested in the business. Why it is to be credited? Because this amount is invested in the business by the Ramesh. So here we have credited the Ramesh. Why? What is the reason? So we have written the reason behind. Cash account is debited because it is received by the firm. Ramesh has invested rupees 5 lakhs and this amount has been received by the business in the cash account. So cash account is debited because it is received by the firm. It being a real account, cash account is a real account, right? Is debited as per the rule of debit, that is what comes in. So in cash account, rupees 5 lakhs has come from Ramesh. Therefore, cash account being the real account has been debited and Ramesh has made investment as capital. So Ramesh's capital account is credited because the firm has assumed a liability toward him. Ramesh has invested rupees 5 lakhs. It is not a donation. It is a liability for a business. That business has to pay this amount to the Ramesh. So Ramesh owes this money to the business. What happened? Just a minute. Just coming. Okay, so it is a liability for the business. Business has to pay it back to the Ramesh, and that is why it is Ramesh account, Ramesh capital account is credited and the cash account of the business is debited. So this is the reason. After the class, you must go through these slides. I will send you. You must try to understand, and then we will again discuss in the next class. So this is very important to understand, and I have given certain examples so that you can understand. You can easily understand. I have written the reason in the behind the each examples slides of the example. Then the second example is purchase a machine from Sonu and Sons for rupees 50,000 on 1st May 2019 and made a cash payment. So a machine was purchased in cash, making payment of rupees 50,000 from Sonu and Sons. How these records will be posted in the journal? How these records will be recorded in the journal? So as usual, as convention, in first column, day, date and year has been mentioned. Year, month and day has been mentioned. Then in particulars, and this is the most important column. Here you need to be very cautious. You must understand the nature of the account. You must ascertain which account is to be debited and which account to be credited, and based on the rules of debits and credits. So here, this requires very cautious approach. Here, we have machine accounts because machine is purchased. Machine is purchased for the business, for organizing the business, for doing the business. So the machine account is debited. And in the next line, to cash account, being machine purchased against cash. So the cash account is to be credited because the cash has gone from the cash account for the purchase of machine. So machine account is maintained on page number 48 and rupees 50,000 is debited under the machine account, and cash account is maintained on page number 51, and again the same amount 50,000 has been credited under the credit column in the cash account because the amount has been paid in cash for purchasing the machine. So reason is machine account is debited because the firm has purchased, that is received it, and it is being a real account. Machine is a real account. Building is a real account. Furniture is a real account. These are the properties. So machine is a real account. It is being a real account is debited as per the rule of debit. That is what comes in. Cash account is credited because the firm has paid cash for the purchase of the machine. It being a real account, cash account is cash account is a real account. The rule debit what comes in and credit what goes out is applied. And here what happens? Here the amount has been gone out. So as per the rules of debit and credit, it has been credited. So here the machine account has been debited because the value worth 50,000, the property, in terms of property, that is a machine, has been received by the organization. So machine account, in the machine account, we have debited the amount, and cash account, because that 50,000 worth cash has gone out for purchase of the machine. Cash being a regular account here also, it has been credited. Then third example, purchase goods for 60,000 for cash on June 15, 2019. The transaction will be recorded by passing the following journal entry. Please again try to understand here. So here in first column, the date we have mentioned, the year, month, and date. Under particulars again, we have to be very cautious. We have to try to understand. We have tried to analyze. We have to find out a certain what is the nature of account, which account is to be credited and which account is to be debited. Here, purchase has been made in cash. So purchase account of the organization account. There are different types of accounts. So purchase accounts of the organization has been debited. and cash account has been credited. Why this purchase account has been debited? It is important to understand here that goods are purchased for the sale, for the business, for making profit. So when we say goods accounts, means the goods which are purchased are for the sale, for the business. In furniture account or machine account, machine was purchased for doing the business. So that was a property. Here it is a good which is purchased for the sale. So this purchase account is to be debited, being the reason that the firm has purchased goods for the sale, and it is being a nominal account since it has been purchased for earning, for the business, for making income. So it is a nominal account, and as per the rules of debit and credit, debit all expenses and loss and credit all incomes and gain. Here what happens? Here it is a purchase, it is a gain. So as per the rules of debit and credit, this account is to be debited. And cash account is to be credited because cash has gone for the purchase of that amount. So again, following the rules of debit and credit, cash is a real account here, to be debited. Credited, sorry, cash account is to be credited. Then fourth example is paid rent of rupees 5,000 in cash on June 1st, 2019. The transaction again will be recorded in the following way. Same date, year, month and date. Then in particulars column, rent account has been debited. What is rent? Rent is an expense for the business. It is an expense. So rent account is debited. Following the rules of debit and credit, it is a nominal account. Remember, rent is a nominal account, and thus the nominal account, the rule is debit all expenses and losses and credit all incomes and gain. Here it is an expense. Since it is an expense, it has been debited, and the rupees 5,000 has been written under the debit column against the rent account. And then cash account has been credited. Cash account is also a real account, and this account has been credited because rupees 5,000 is paid. So it is an expense for the business. And the same amount has gone out of cash account, 5,000. So the amount 5,000 has been credited. Then fifth example is paid a creditor rupees 5,000 on June 1st, 2019. Here again, it is necessary to understand that rupees 5,000 has been paid to the creditor. Creditor account is debited because the firm has paid liability towards a creditor. The firm owes rupees 5,000 for the credit amount which has been purchased by the firm on credit. So firm has to pay rupees 5,000. Rupees 5,000 is a liability for the firm for owes rupees 5,000, and thus creditor's account has been debited. And again, the amount is paid in cash. Cash account being a real account, as per the rule, debit what goes out, it has been credited. Then next example is